Welcome to Bruegel. It is really a pleasure to see a full house today in person. Also, hello to those of you on the web. We are here today to talk about a new book, Principles of Sustainable Finance, written by Professor Dirk Schoenmaker, who is here and is going to tell you all about it. My name is Rebecca Christie. I am a visiting fellow here at Bruegel. I have been since last month. This is my first public event since joining Bruegel. Some of you may know me from my previous life in Brussels at Bloomberg News. Delighted to be at Bruegel now, working with a great bunch of colleagues and a bunch of interesting topics. Dirk will tell us all about his new book, and then we are very privileged to have Mario Nava from the European Commission to talk also about the book a little bit and also give us a sense of where the European Commission is on these important issues. And then we have Pascal Corret from Caisse des Dépôts, who will give us a more market-oriented perspective of maybe how some of these issues play out in practice. So that's where we are today. There will be questions at the end. If you have quick questions during the course of the presentation that are short questions with clarifying answers, please feel free to ask them. If you have a comment or a more tangential question, please save it to the end. The discussion in the room is always one of the fun parts of these events, so do please take part. And with that in mind, I'll hand it over to Dirk.
Thank you, Rebecca, for the introduction. I will stand up if that's all right, and I can see you a bit better. Good to see that there are so many people here today. And I have to say this is really a topic where the sector is far ahead of the academia. And I'm also happy to say that policy making is also ahead of academia, because I think 1 year ago the high-level expert group started. And so lots is happening. And that's why we wrote a textbook, also to educate the young generation that there is more in life in finance than only profit maximizing, because there are current textbooks in finance. And that's not a joke, that's a reality. So, what do we do in this book and in the presentation? First of all, it is really important that we cross bridges. Whether we are economics or business or finance, we really need to know what sustainability is about. And then the second part is it is not about the financial sector itself, but it's about where they invest in, where they lend to. So it is about the real world of companies, governments, where they lend to. Are they sustainable or not? And what can financial institutions do about it? And that's happy that also a bank is in the panel to how they direct their clients to that field. And then finally, we talk about the role of the financial sector and how the financial sector can transition itself to this new world. And if you come home tonight and you are asked by a partner or whoever, what did you do today? There is one key message from the book is, we have to move from F, this, maximizing the profit financial side, to optimizing the integrated value, which is a combination of financial, social, and environmental value. That's the big challenge, and that's the journey I would like to take you on this afternoon. Okay. My favorite is always physics. I almost did physics, but I ended up doing economics. But we need a hard science. And I show you this picture. Stockholm Resilience Center is doing a lot of work on this. 9 planetary boundaries. And I'm not going to discuss them in detail, but just to show to you that climate is only one of them. And there are other issues, biodiversity, land system change, what's happening in the oceans, fresh water is getting scarce, what's happening with biochemical flows, that's basically fertilizer used in agriculture. So there are more issues around on the environmental side. And in the financial sector, we look at risk. The precautionary principle of environmentalist is, if you go from green to yellow, then we have already past the planetary boundary, then we should already take care, because we cannot redo it if things go in the red zone, then we are too late. And just to show you, these are the annual emissions on a global scale. And the middle one is the policies. And the below one is what we should do if we want to go to 2 or 1.5 degrees. So, in other words, we are still far away of getting to the target, even with all the current pledges. And my main message to you is, the later we start to go to the lower one, the bigger the step we have to make. This is some kind of budget. So if you start early, you can do it a soft landing. If you do it late, you need a hard landing. You know it from currency crisis. This is the same. And we are heading for the late one. So that means that maybe in 5 or 10 years' time, we don't get carbon taxes of 20 or 25 euros, but of 100 euros. And what happens then to your assets? That's the way of thinking about the issues. The longer you wait, the more you have to do. In addition, it is not only about environmental issues, it's also about social issues. Some of you may remember the Millennium Development Goals, where many of these were addressed. Poverty, hunger, access to healthcare, education. They're equally important in the whole sustainability debate. Kate Rayward has been quite active on this, and I will show you in a minute how to make it operational, because this is a nice list, what to do about it. So these planetary boundaries and these social foundations are really the bedrock of the Sustainable Development Goals, which you probably all have heard of, the 17 goals. I won't mention them one by one. So they are really based on environmental and social science. But then the question is, what can the financial sector do about this? How can they add to it? And just to give you an example, an idea. So one of the SDGs is decent work and income, which we can call a living wage. That means a wage which is adjusted to the country where you live. So the living wage is higher here in Belgium or in Europe than it would be in Bangladesh or Vietnam. So this is the living wage adjusted to the country. And if only companies would adhere to the living wage and say, in our value chain, wherever my garment, my clothes are made, I pay the living wage. Then if they will do that, so they will just have that as a policy, then a lot of other things can happen. Because if they pay a living wage, the person can then, with a living wage, support its family, his or her family. So that means no poverty, no hunger, but also access to healthcare, because they can pay for it. And most importantly, you don't need child labor for your children anymore, because you earn enough for the family, so your children can go to school. So by just paying a living wage in your value chain, a company can contribute to 4 SDGs. And that's the way we can make sustainability operational. The next thing is, this is called a wedding cake. I reorganized the SDGs. And you don't have to be into construction to know that the foundation is always the most important. And when we had this picture at the first time, I'm also at the Rotterdam School of Management, then our dean said, yeah, we are at the business school, so we are at the economy and the rest is for the others. But that was when we were starting the journey, our own journey. But it's quite clear that if we want to make work of it, that we need to look at all 3 levels, and that the bottom one is the most important. We need a livable planet for societies, and thriving societies need an economic system to organize production and consumption, but it's not the other way around. So GDP, profit making is often taken as the ultimate goal, but if you leave the other 2 out, you may find out that your foundation is lacking and that you're falling away. I've translated this to simple factors, and this picture is made by my daughter. So finance, social, society and environment. So these 3 factors I'm going to play around with. So This is really one of the key slides. If you would ask an economist, how many economists do we have in the room? I'm also one. And how many lawyers? And how many from science? Good, a few. And from social sciences? Well, and quite a few other people. So really a diverse group. And we all have our own training. And I think whether it is sustainable finance or whether we talk about sustainability in any other field, it's about crossing bridges. And let's start with this bridge. If we ask an economist, well, it's a public good, clean air. It's not price, so sorry guys, we cannot do anything about it. Maybe if we are lucky, the government has a carbon tax or an ETS price, which is high enough, but if not, then we are sorry. When I present this to economists, they really believe that private finance cannot add anything. It's all about the government, and if the government is doing nothing, then we are doomed. So that's the economist. If you would ask a human rights advocate in his or her first year of training, she will be thought that, of course, life's essentials are really crucial and are an irrevocable right for every person. There's no way around it. Finally, if we go to the hard science, the ecologists, I was in a presentation and she said, I cannot understand that economists call this externalities external. Well, this is the foundation. If we don't have the nature in order, we cannot live. So how can we call that an externality? So it's quite clear we need to live within these planetary boundaries. I just show you these three perspectives, which are not complementary, but are really different. And you need to cross to the other two, from whichever one you are coming, to really understand the issue. If you don't do it, so if you are doing ESG investing, but still you're looking for maximizing profits, and that's it, not much will happen. So you really need to accept that you need to integrate the three elements. And that's what I call sustainable development. So yes, the ecologist also needs to accept that if we do investment in nature, we need to return to make sure that the investment can be renewed. And also, so we need all three to make it happen. Then what to do? So now we go back to finance after this little introduction, and I'm already halfway my time. What can we do? The old model is the shareholder model. We just maximize finance, and we can refine it a little bit so we don't do cluster bombs anymore or tobacco, but otherwise we do the same. So that I call it refined shareholder model. A completely different perspective, which we know in continental Europe as the Rhineland model, the stakeholder model, is that we look at other stakeholders, including society and environment as well. That's number two. And number three are the leaders, but it's a small fraction. That are the impact investors. They look at impact first, and only check in the second round whether the financial soundness of the business proposal is okay. But the first round to check on impact. They're leading the way, but my claim would be in number two, that's where progress can be made, if we move from 1 to 2. And just to show you, if we look at, for example, just tobacco, which is easy to understand. If we look at the full picture, the integrated picture with all three elements, they make a lot of profit, tobacco companies. Employment on the plus, but we all know premature death, extra cost of healthcare. And if we sum them up, you don't have to be a genius to know that net return for society is negative. But our financial system only notices the profit. So investing in tobacco is very profitable, so it's very difficult to go out because you would forego profit for your pensioners. And that's the struggle we are dealing with. But why would we integrate sustainability? I put 4 reasons down. The first one is anticipation of regulation and taxation. This morning it was announced that the committee in the UK said we want to be carbon neutral by 2050. And then you know they have already carbon tax, they will increase it to get there. So it is going to come, like UK is a front leader, France is quite ahead, Sweden and the Scandinavians were really ahead of the game. I'm behind an initiative of economists in the Netherlands also to go for a carbon tax, so we are on the border of doing it. It is still not clear, but it's going to happen. So you want to be ahead of the game. The next thing is reputation. Your customers are asking for it. My favorite one is just a business case. If you believe that there's a positive probability that some of the SDG agenda will be achieved in one way or another, that means we don't have business as usual. And it means if we don't have business as usual, if you are investing and lending in business as usual companies, they may miss the future, like Kodak on digital or IBM on personal computers. So the world, the companies are faster than academia or the financials. They are moving towards SDGs. So there's also a business case for moving along and even be a front runner. If you are the first one with renewable technology, then that can be an export product. And the final one is, that's for everybody personal, there's also, of course, a moral responsibility. So how to do it? In the last few minutes. This is all about the long term. Sustainability is not about the quick wins. So you flip in and you flip out. So it's really about you believe in a company and then you stick with it unless new information on the long term strategy arrives. You don't look at daily noise. So you really need to know the business model. How is this company prepared for the transition? Not where they are today, because almost nobody is fully prepared. But what? Are they aware of the issues? Are they preparing themselves for the transition? Are they early in the game or late in the game? So we want to know, uncover the social and environmental value of companies. And that means you really need to dig into the company, and a rating, like a credit rating didn't surface the AAA before we went to the financial crisis. In the ESG rating does not surface to know what is going on. You need to do your homework. That's my main message. If you really want to know how well the company is prepared for the future. And then the next thing is, at school, we learn the students diversification, and you may remember that portfolio theory, Markowitz, you need to invest in the whole market. They are extremely well diversified. Well, in reality, with 50 or 100 shares in really different sectors, you're already quite well diversified, and the additional benefits of lower risk, lower variance, is almost zero if you go beyond 100. So in reality, you could run a concentrated portfolio of 100 shares and do real engagement with your companies. Alecta in Sweden, a pension fund, is doing that already for years, and the example is explained in detail in the book. So it is possible, but our old theories of efficient markets and portfolio theory are holding us back. And then I call it the virtuous cycle. So you do your fundamental analysis, what's in, what's out. Then you have a concentrated portfolio, and importantly, you have a dialogue with the companies. You ask them questions, you steer them towards more sustainability. They tell you what they are doing, so it is really a dialogue. And in that way, you can reinforce each other. I have no time to do banking as well, but it is exactly the same, and I'm happy that later on in the panel banking will be covered. And I just put down a few examples. Westpac and Rabobank have policies. ING and some other leading banks in Europe are working on transition technology. So is the technology of the client in line with where the sector is going, or are they behind or ahead? And the main message is, environmental and social issues are really influencing creditworthiness. And I can have the same slide for government bonds. But we have no time for it. So it really affects all asset classes. Also, if you look at commodities, hedge funds, private equity, whatever you have in your portfolio, you can check the sustainability of the underlying asset class. So finishing off, it is really about moving from the F dimension, as I call it. It also reminds me of in football we have always the F side that are the supporters. So I hope for them tonight that they do well. But otherwise than football, we have to move really to integrated value and look beyond that. And that's the sums, the calculations are easy to make afterwards. It is really first about mindset. Are you open to look at these sort of issues? And then the news is finance is about anticipating. And really, to give you an example how far you can look at, it is not only about the big oil companies. So on transport, there's a big user of energy. So we are going to electric cars, we are going to car sharing. If you have car sharing, you need only one car for 9 people. If you do that smart, that means that the parking lots which are built in cities become a stranded asset in 5 or 10 years' time. So that's the way to look at your, so the electric car makers, they are in the plus, and these car parks are in the min. So that's the way you have to think about a transition. And that means whatever sector you're covering or you're working in, you have to try to think about what could happen in this transition and prepare yourself. And that's exactly where finance could be very strong in. Thank you.
Thank you so much. It's a pretty great overview of the book. Again, the book. Order it for all of your economics classes coming up. Mario, what do you think?
Thank you very much. And good morning or good afternoon, everybody. I have 2 tasks, I understand. One is to tell you what and why we are doing what we are doing at the Commission. And 2, link it to the book, which came afterwards, of course, but I think it helps anyhow, so I think you should buy anyhow. First of all, before coming here, while I arrived here, I was chit-chatting outside with the several friends that are here. Best conversation was with a good friend who told me, you know, I was here yesterday for Brexit, it was empty. Today for sustainable finance is full. I said, obvious. It's exactly right. That's the future. I mean, sustainable finance is the future. I make no comment on Brexit, but sustainable finance is absolutely the future. So you are completely right to be here in this room. Incidentally, I've been invited once or twice to this room, and I don't remember that it was so full. So great. Why I think is in the book, and you have already explained it. But the point I want to explain you is why private finance? Because that's the issue. I mean, sustainable finance is the marriage between 2 things that normally do not marry, do not even flirt. And why now we are trying to marry them? I mean, the reason is actually quite simple. The fact that in order to respect the Paris Agreement, in order to respect the engagement and so on and on, it has been measured we need between 200 and 300 billion a year. So 200 and 300 billion a year, that means of additional investment. That means a lot of money. And even worse, it means a lot of money now, because we have till 2030 in order to be able, and that was very clear in the graphs of Dirk, in order to be able to keep below the 1.5. After 2030, Serate. So we need lots of money, and we need them now. And this is not exactly public money. Public money are neither a lot, neither now. So that's why we are trying to do this flirt between private finance and sustainable issue. Where I'm saying a slightly different thing from Dirk is that Dirk explained you, if you want, a sort of a rational world, where rational does not mean only economics, and that is extremely welcome. Rational from different point of view, the scientist, the economist, the environmentalist, and so on and on. That is very good. But the work of Dirk, the book, what I've read, at least the part I've read, is normative. It tells you as it should be. The fact is that we as policymakers, like it or not, often not like it, but still, we have to deal positively with people as they are. Now, I have been talking to bankers, apologies Pascal, Elizabeth, and the others, for a number of years now, and two things I have understood. They make no charity, and they don't give a particular toss about the I that is in the book there. The only thing they care is the F. So, or mostly the F. Now they are changing slightly. We have done a couple of directives, the non-financial regulation directive. We have done a couple of other things to try to move them a little bit. But in short, that is the starting point at least. And then we hope that there is some behavioral economics and things would change. But if that is the case, if the way you get a banker, an investor, someone who has the 200, 300 billions a year is through showing them the color of money, that's the way we need to talk to them, because that is what they understand at the very beginning. And how do you get them, how do you get their money, how do you get them to invest on that? The argument we made is relatively simple, is if this is not done, so if there are not between 200 and 300 billion a year of additional investment on the SDGs, to cut a long story short, but let's say on the 17 SDGs, what happens is that there are big risks. And there you already start seeing the eye of the bankers blinking, because what they understand is risks equal returns, equal opportunities. We all know no risk, no return. Lots of risk, lots of returns, lots of opportunities. And then you start seeing things coming up. For example, one example, which I'll give you, very simply, is green mortgages. You walk in any bank, they offer you a green mortgages. They are all green, not the least. The fact is that if you do a green mortgage, the value of your house goes up, the loss given default goes down, your PD goes down because you pay less for heating and you have more money to pay back your mortgage. So that's it, as simple as that. So what we had to look was simply to look at ways through which you create values, or given that we are in finance and finance is about anticipating events, you create expected values. And that's, I would say, is really the driving intellectual force of the job that the Commission, with the help of the high-level group, has proposed. Now, when we want to reorient behaviors, because basically here the objective is what? Is to reorient behaviors in order to reorient capital flows, right? We are trying to do some public policy with the money of someone else, essentially. If we had the money, it would be much easier. We don't have the money, so we have to do some sort of decentralized demand policy, more or less. And we have to make sure that the others follow us and listen to us. From the three typical patterns through which you can make that is one, making things more transparent, increasing transparency, disclosure. For those of you like me who have followed Basel and Basel rules for many years, this is called Pillar 3. So Pillar 3 clearly is something, as we all know, it works a lot when there is market pressure. So if you have market pressure, and here we have market pressure, you use Pillar 3, you use transparency, you use disclosure. The other thing you can do is one thing that also Dirk showed, which is moving from short-term to long-term, something that, thanks God, the European rules had already since 2012, 2013. We had a number of rules on deferred profits, deferred payments, deferred bonuses, and so on and on. And the third one is, of course, to impact on the companies themselves, on the fact that they need to explain what they're doing, and if they're doing nothing, explain that they are doing nothing and hope in the market, in market pressure. So basically, our strategy was, I repeat, given that we decided not to go for a constraining strategy, we decided, at least for now, not to go for a so-called Pillar 1 strategy, so no green supporting factors, no brown supporting factors, and all of that. Then the strategy had to look at the investment from A to Z. So we had a regulation on disclosure and advice. That normally happens before you invest. You search for an advice. Then we have a regulation on taxonomy, which basically tells you these are the areas that do well to the environment. Then you may or may not invest. It doesn't matter. You need to disclose what you do, but you may do it or not do it, and there is no pillar one impact. And then we had the regulation on benchmarks. And now the incredible thing happened. I mean, we had an action plan, March 2018. We put out the 3 regulations, May 2018. Many people said, well, the usual 18 months, 24 months for the Commission, the Parliament is off, goodbye, lost cause. No. I mean, March this year, 2 regulations out of 3 were in the pocket. With the usual drama, 5 o'clock in the morning. I'm sure there are here some MEP's assistants that were with me, but okay, fine. Doesn't matter. We know ça fait partie du traitement. So, but still, I mean, the crucial point is that in 10 months, May 2018, March 2019, we brought home 2 regulations. In 25 years, I do not remember such a speed. Again, as there is market pressure, there is government pressure. I mean, it's very clear that the federal governments, and now I go to the one we didn't take home, okay? So I'm not trying to noyer les poissons. I mean, I know there is one, which is taxonomy, that is not yet home, and I get to that one. But the fact is that why MEPs, government, and everybody was particularly reasonable and allowed us to bring home 2 regulations in 10 months. I believe because they simply saw there are no choices. I mean, there is not only the kids, including my kids, that stroll down Rue de la Loi every single Thursday or Friday. There is not only Greta, but there are, for example, the towns. I mean, if everybody of you has an oldish car and frequents 2 or 3 towns, has noticed that, for example, I have an oldish car, I frequent 3 towns, Brussels, Milan, and Düsseldorf. I'm sure they don't even know the telephone number each other, and my oldish car is banned in the space of 6 months from the 3 towns. So it's very clear that without any coordination whatsoever, the towns responding to, let's say, popular or civic or whatever other pressure, they do something that then forces people to do it. So governments have probably understood, anticipated, and the same for MEPs, and we are there. Is missing an important thing, and I'm about to close, is missing an important thing, which is a taxonomy. Actually, it's not exactly missing. I mean, we got an agreement in Parliament, which is much better than nothing, believe me. So we have got an agreement in Parliament. Parliament finished, as we know, at the end of last month. We are working with the Romanian presidency. We hold hopes to have a general agreement in Council under the Romanian presidency. If not, we have the next presidency, which is the Finnish presidency, which is very interested to the dossier, and we really hope that the general approach in Council and the trialogues, and therefore the successful conclusion of the regulations will come about. So basically, what we have noticed is that in 10 months we have 2 bits of the main action plan, and the third and most important bits we have, I think, very reasonable hopes to have it in 15, 16 months, which in European terms is quite a lot to say, because normally this does not happen. It takes much longer. Conclusion. I think this is a subject which has lots of support from all sides. And this is very different from other subjects. There are other subjects which are much more controversial, where people tend to go in different directions, where the interests are very different, and so on and on. Probably the eye, which I take from the book, is that the integrated means that everybody deep of his heart knows that this is a subject that will impact to us one way or another, and therefore there is support from the civic level, the towns, the MEPs, the government, and so on and on. Why should you buy the book? because I need to say it. Why should you buy the book? One, because it fills a vacuum, in the sense that I think it puts together lots of ideas and things that you may have heard, hinted, or intuited here and there, but you haven't seen them in such a analytic and a structured way. And I think the added value of the book is really the structure, which is extremely well done with the wedding cake and so on and on. And two, and this was a great lesson to me, because is a teaching book which does not equate for once rationality with profit maximization, and that's the main progress. Thanks a lot.
Thank you so much for that. Great summary of the book. I have to say, when I looked at the slides for the first time, I thought they were donuts, not a cake. So that tells you where my mind is going in terms of dessert. Pascal?
Two questions: why and how? Why should I think it's simple. The usual answer of an asset manager of a bad guy. I'm not a bad guy. I work with Caisse de Dépôt, which is a long-term investor, and we try and be as responsible, as sustainable as we can. But the usual answer of an asset manager when you ask him what you're doing, he's saying, I'm maximizing profit, I'm maximizing the, for instance, as a pension fund, I make sure that my customers can pay their rents and their pensions. That's the usual financial answer. The sustainable finance answers, okay, well, I'm going to make sure that the pensioners can have their money, but I'm going to also make sure that their children have a job and that their grandchildren can play outside in the schoolyard, even on polluted days, instead of being kept inside as they are sometimes in Paris when there's pollution. So that's why. The question is how. In the book there are many answers, and the big one, I think, is to you allude to it, is to rethink the macroeconomic theory. We are not, all of us, we are not profit maximizers. We are we have another utility function. We are not homo economicus or persona economica. I've never met any homo economicus. Thank God they don't exist. But the entire classical economic theory is based on this utility function. It's quite helpful. It's quite easy into models. You mentioned the Cobb-Douglas protection fund. It's dead. Market efficiency, another big dogma, I would say, or myth. It's not working. Well, we should know after the great financial crisis, 2008, it doesn't work. Markets are not efficient. What else has to be rethought? Portfolio theory, Markowitz. Obviously, based on, if the first assumptions are wrong, that portfolio theory that derives from those basic assumptions.
Are still teaching it.
That's amazing. I've been taught that 30 years ago, but apparently it's so this should be given free in all business schools. But everything derives from that, and we have to think growth in another way. And there are some schools already working on that, on endogenous growth, but it's a long way. But the framework has to be changed. In the meantime, it's going to take time. In the meantime, what can we do in terms of sustainable finance? First, we have to convince people that all the hypothesis the work is based on is wrong. But this room is full. Imagine if we were in Washington, D.C. or 1600 Pennsylvania Avenue and the White House. I'm not sure I'm not even sure we could have this meeting. So there are some deniers around, and well, it depends for what reasons. There are some profit maximizers around the world, no? But for the others, the skeptics one, I would say taking account these sustainable finance items is about risk mitigation. Authors, not only environmental risks, but social risks. Think yellow vests in France. Big demonstration, biggest demonstration in France in 20 years maybe. Why? Well, the carbon tax was the trigger, but the root for that was the perceived increase in inequalities in France, and people reacted to that. So social risk is an issue, and it's an issue also for governments, for government debt. The first government's answer in Paris to the Yellow Vest demonstration was to spend 10 billion euros end of December, and then they added another 5 recently. That's pure budget expenditure. Budget deficit is on the rise. When the President Macron announced the first 10 billions, the 08s, the French debt saw its premium against bonds increased by 10 basis points. 10 billions, 10 basis points. Easy. So it has an impact immediately, and that's social risk. And governments, the government's risk, well, you think, I don't know, Dieselgate, Volkswagen. So there are many risks that can be mitigated if you take, well, it's the usual ESG factors into account. And that's, even if you are risk profit maximizer, you have to take that into account. Those risks are material. The thing is, you don't know when they are going to materialize, but still, it can be any time. So even if you're thinking short term, you have to take them into account. And with this, with those ideas, credit rating agencies are improving the way they take those ESG factors into account. 3 or 4 years ago, when we were discussing with them, with the UNPRI, they were like, well, no, we don't take that too much into account, it doesn't really matter, and within 4 years, they make huge progress. In terms of their methodology and the way they tell to their customers how they integrate those factors. So it's quite an interesting development, I would say. Then, if all this is not enough, you cannot really force people to change their mental framework, but you can incentivize them. And it's been mentioned already a couple of times, but this disclosure is key. Telling or asking companies, but only companies, portfolio managers, to say what's in their books or what's in their company on those risks, CO2 emissions, social issues, exposure to risk like water scarcity. That's a major thing. And just by asking them to tell everybody what they're doing, it will be quite efficient, because they will compare, obviously, what their neighbors, what their competitors are doing, and over time we will see who's making progress and who's not doing progress, and that's a quite efficient way to achieve those an evolution. But that's mostly within the corporates, the firms, and they will need to provide data that are still not available. That's a major issue. In terms of integrated value, I've got a few questions, because we have to put a value on those items. It's not easy. But still, on some elements, it's possible, but the data are not always available. And the question is, who has to provide those data? There are many private sector independent data providers on CO2 emissions, on that kind of issues. We've had problems with those data. The other day, we almost sold bonds from an from a utility that had reached a certain level on their thermic coal exposure. And we almost sold the bond because we were reaching the threshold where we think we shouldn't hold that kind of coal exposure. But the portfolio manager said, something's wrong with the development, I'm going to call the company. And the company said, oh yes, this is wrong. The data provided by XYZ is just wrong. So the reliability of data is key. The question is whether those data should be provided by the private sector or by the companies themselves with an audit, just like any financial account. Financial accounts are reliable because they're audited. Maybe external financial data could be provided by the companies but also audited. That would be a great help for us. But yeah, disclosure, I mean, is quite efficient because otherwise. Portfolio managers, if they're not convinced, they will still, well, I know the story, many of them still think that their job is to provide value by beating their benchmark. That's a nightmare. This is not how we work. If you think sustainability means long term, meaning in long term you have to know what you're doing, you have to know what you're buying, you have to do your homework. I totally agree on that, but it's time consuming. But at least you know the risk you're doing, and responsible investment means also that you have in that case you are responsible for your choices. You don't buy a benchmark. Buying a benchmark, well, all you've got to decide is whether you have to be overweight that sector or underweight that name. It's not the same as, okay, I'm going to go long this company and I'm going to skip that one, or company or country. And tell you what, in our large cap equity portfolio, we have something like 130 names. In the corporate bonds, it's around 120. And on the government, on the sovereign side, it's even less than that. Our non-European core portfolio is less than 20 names. But it takes time. We are not traders. When we buy a company, we keep the equity for 5, 6, 7 years, not months, years. And the bonds we are holding, 90%, 95% of them we're holding till maturity. But it takes, well, you have to be careful and you don't trade every day. But even as a portfolio manager, it's much more satisfactory that taking long-term bets to see that at the end it pays. Actually, it pays. But one last word. The thing is, working that way, your boss or your competitors will compare your performance to the others, and so the easiest way is the benchmark. But let's forget that. So the two measures are possible: a peer group. It's in the book. It's difficult, but it's workable. It's another type of disclosure, and otherwise, I would say the solution I would advocate for is absolute return, because give me an absolute return target, and I'll tell you what kind of risk level I have to take to reach it. If it's too low, it's going to be too easy. If it's too high, I'm going to tell, well, I'm going to go high yield. I'm going to go. I don't know, buy frontier markets, and you're going to say no, and then you will reach an equilibrium between what kind of risk is acceptable and what kind of return is needed, and maybe we'll see in that case that the needed risk or the accepted risk and the yield and the return that is achievable is much lower than the 10% ROE that some people are asking for. And in that case, that certainly would be more sustainable if everybody is expecting a return on investment that is much closer to what the economy can provide.
Dirk, would you like to respond to some of those thoughts and comments on the realities of this?
Yeah, and thanks both of you for the perspectives. And let me start with the last one, because that's exactly what it's about. It's about the real economy. How they move from today, linear, non-inclusive, to an inclusive, circular, sustainable economy. That's the trick. And at the macro level, exactly as you said, we had the Stiglitz report. We have to think beyond GDP, but the other factors. That's the big element. And then the question how to do it. How can the private sector do it? In chapter 8 is the equity chapter. And in the end, it's about companies. We have a list of 26 questions. That sounds a lot, but it is not. Students are doing it as an exam. If you answer these 26 questions, you have done your fundamental analysis of your company. So, so don't focus on the large number, 26, but it is doable, this fundamental analysis. And you're doing it with slightly over 100 names. Alecta is doing it. So I expect that for the deep sustainable investing, this is we see more of these concentrated portfolios. But the main message, it is doable. And going back to Mario, thanks also for your great comments. And yes, it is all about reorienting behavior. That's the big challenge. And then we have to leave some old theories and some new theories. And indeed, transparency can help a lot. In the French law, we already have this article for companies and asset managers. We're getting more of that now at the European level, the task force of Bloomberg. So if it is clear what the issues are, and then we have to move beyond climate. So water scarcity is meant, are you paying living wage in your value chain, that kind of issues. Then we can really move on the ground. And a final word, two Americans, but coming from the UK, they've really, because the word stakeholder does not exist in the US. So they call it still not shareholder value, but shareholder welfare, what we would call a stakeholder model. And that is Oliver Hart and Luigi Zingales. And they say shareholders are also human beings. And they say they call it pro-social shareholders. And that's a driving force in their model, and that's one really a refreshing way of looking at it. And I think both of you said the same. That's one way of looking at it, that at some point we can start to think beyond the F.
What a great way to sum up the discussion so far. Before we move to the audience Q&A, and please be thinking of your questions, please take this time to reflect on how to make your questions short and question-shaped. That usually leads to better answers. But I'm going to throw out the first one, which is whenever sustainable finance has come up at events that I've been with, there are usually three things that come up every time. One is scale. How can you do enough of this to make a difference? The next thing is definitions, and this comes back to the taxonomy issue. What is a sustainable financial investment, and how broadly can you define that? I had one portfolio manager say, well, we invest in government bonds, and governments are made of people, so therefore it's all social. And then the third question comes back to this issue of the financial side. And the question there is, can we expect this to be profitable, or should we resign ourselves to its unprofitability and try and offset that with tax and subsidies? Certainly in the US, where a lot of pension investment is privatized, I've heard over and over again, anecdotally from friends, yeah, I really believe in the environment, so I invested in some sustainable finance mutual funds, and wow, I got hosed compared to the index, so I eventually had to give up. I couldn't bet the farm on that. So how would you respond to those themes? I'm sure you've gotten those questions before.
On the scale, I call it tiptoeing. So the pension funds, if you have 400 billion, you put 5 or 10, if you are courageous, you put 10% towards SDGs or whatever you call it. And I think we are beyond that. We should go with the full portfolio. And I have the feeling that Pascal is already doing it. Alecta, for example, is doing it. So this tiptoeing is not the way to go. And as I said, all asset classes, so government bonds, not, as you said, the shortcut, but the real one is, for example, Robeco Sam, they have sustainability ratings, which are correlated with credit ratings, but still different. And guess what? The Scandinavians are top of the list, not only on credit, but also on sustainability issues, social and environmental. So you could look at governments also on the sustainability lens. And if you think about it, if you have solved your pension problems, you have equality in your country, you've solved your energy infrastructure like Sweden, then there are less government expenditures in the future because you've solved already quite a few of them. So in that sense, it contributes, again, coming back to the financial issue, to your future budget surplus in Sweden. So scaling up means all asset classes and not tiptoeing anymore, but summer is coming, take the dive, get wet. And then sometimes it is unpleasant. And that discussion is very difficult, Rebecca. For example, Matt Anderson with Patrick Bolton and Samama, they've made this portfolio and tracker on carbon, but with less carbon in the portfolio, but a small tracking error. That happens to be in the plus at the moment, but it could be in the mine as well. So the key thing is, if you're not prepared to let the market index go, then we will never win the game. Because then we are in the old thinking, we are in the portfolio thinking, because no market index will pay your pension. Only investments in the real economy will pay your pension. So if we don't dare to let this market index get out of our mind, we will never get there. Because today you can be minus, tomorrow you can be plus. So you make a game, there is no reason to win it. You mentioned absolute return, that's what counts. So if we are not able to go outside this benchmark thinking, we are not making progress. So that's old habits, let go. And on the taxonomy, it is helpful to get rid of a lot of greenwashing. But as I said, sustainability is about transition to the new world. It's a forward-looking concept. And it's very difficult to catch into definitions. So it is a flexible, dynamic concept. So what I hope is that if the taxonomy gets there, that is used in a flexible way rather than in a static way, stifling innovation. But if you look at it as a flexible, dynamic field, then we can make progress.
In that perspective, the 17 Sustainable Development Goals are quite helpful. If you want to define a strategy, sustainable investment strategy is quite helpful because you have to you can choose to put your focus on a given or a set of objectives, but it's tricky. It can be very tricky. For instance, do I have to buy a green bond issued by Poland because it's green, or should I skip and avoid this bond because it's issued by Poland, which has some Article 7 proceedings risks? Yep. Carbon footprint versus justice. Yep. You have to. It helps you define what you really want to, where you want to put your money in, but it helps thinking. Huge debates.
Maybe one thing on taxonomy, because one of the reasons why we haven't yet got approved it are exactly the two issues that Dirk mentioned. One is flexibility and the other inclusiveness. Because on inclusiveness of taxonomy, there is the temptation to be purist than the purist, and so to have very little. Great, probably very clean and very green, but not helpful. And so you need to understand that these probably, in a way, and I hope not to shock anybody, but our best friends in this moment are the biggest polluters, because it's them that we want to reduce. So it's them that we need to take them in and put them on a transition path. And the second point is exactly the transition path. We are not conceiving a taxonomy as a piece of law to which Council and Parliament are used, which is you do a piece of law and end of the story. We are conceiving taxonomy as a series of delegated acts. Delegated acts means power to the Commission, blah, 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 they like it less. But so it is. I mean, if you want to have something which evolves, Dirk said evolves continuously, That's what you need to have. You need to have something which is relatively flexible.
I'm thrilled that we have a whole half an hour left for Q&A. So I hope you've thought of some good questions. We'll take them in batches of a few at a time. Let's see. All right, we have back here in the pink shirt, yes, and then in the blue, and then over here in the corner, and then you'll be the first of the next round, or maybe we can see. But let's start here.
Hello, my name
Please
is...
introduce yourself. Yes, thank you.
Does it work? Yes, Stan Jordan, Put the Money Europe. We're an NGO working on sustainable finance and central banking. Talking about benchmark, because not only investors are just following the benchmark, central banks are doing that too. They just call it differently, they call it market neutrality. And I know that you've done a paper on that, on the corporate bond purchase of the ECB, so I'm a bit curious to know what you think about that, and also because there was a big report I think 10 days ago from the NGFS network, so what's your take on this? And also I read an interesting paper recently on by the Bank of France, showing that if you compare car loans with the interest rate on car loan versus energy efficiency for housing, like household housing, you've got a 3 points higher interest rate, if I remember correctly. So basically, the market is saying it's fine to buy more cars, but it's not fine it's more risky somehow to renew your house to make it more energy efficient. So, I mean, is that really efficient? And what could, maybe central banks should do something about this. You know, they're buying asset backs.
Okay, thank you very much. I will rearrange the question asking a bit because we have 3 in this central section. So we'll give it to the guy here, and then in the blue shirt, and then you 2 over there I saw for the next round, and we'll move the microphone over. So thank you.
It's Gabriele Salvo here. I have 2 issues. The first one is you rightly say that the way forward is to integrate the E, the S, and the F. But the difficulty I foresee is, first of all, you need to evaluate. You need to put a value in all these 3 types of capital. And this, as you know, it's a controversial issue. The second thing is that you need to make some trade-offs between the social, environmental, and financial factors. So this is another controversial issue. So how would you go to tackle these 2 things? And the second issue I wanted to talk about is, I think that in order to really advance the sustainable finance in an efficient way, you really need to reform classic economic theory. And you mentioned it during the presentation. You talked about portfolio theory that is still present. Neoclassical economics is still mainstream. In your book, I'm really glad you mentioned a bit of ecological economics and the work of Elinor Ostrom. So what do you think, how can we make this unorthodox economic narratives, how can we bring them into the mainstream? Thank you.
Okay, and then two over. Yes, thank you.
Thank you. Jack Schickler from MLEX. I have a question in particular for Mario, because as Rebecca says, once you get into the details, you get into issues like definitions and you get into very politically contentious issues. However great the consensus is over the principle. So the Parliament, for example, has attempted to remove nuclear power from the scope of the green taxonomy by saying that any process that has non-renewable waste products cannot be counted as green. And this could have unintended consequences, as some people pointed out, because even a solar panel has to be thrown away at some stage and may not be renewable, so you'd have excluded solar power from your green taxonomy. Are you worried that's a genuine problem, and how would you avoid this and other unintended consequences of any kind of taxonomy?
Thank you. We will bring that back to the panel and then move to the next questions. I'd also like to say this room is wonderfully about half and half men and women, but almost all the speaking is happening from men, except for me. Hi. So I would love for more voices to be heard. One thing that comes up over and over again in global sustainability debates is we're not hearing enough from voices outside the Western European, white American, male mainstream. So any of you who are other voices, please participate in the conversation. Think of things you want to say. It will help all of us.
Yeah, on the central banking issue, I did this paper on greening monetary policy, It's a bit, you probably know that's a bit tongue-in-cheek paper. You write these papers and you know it's quite logical, but that people don't like it. And so you've one person, so you have a central banker. When he's putting on his dark hat of financial stability, it's looking very serious, and tells all financial institutions you have to take care of environmental risk in your portfolio because it can go wrong. Please take care, otherwise we will come after you as supervisor and we do a climate stress test. Then you turn around, you put your light hat on of monetary policy, and then you have your portfolio and people ask you, maybe you can clean up a little bit your own portfolio. No, we do price stability, we are holy, and price stability should not be affected. And why are you asking me? Next time I have to do gender equality and tomorrow something else. Why are you asking me? I find that a bit schizophrenic. If you look a bit further back, and I think Mario said it, it's about behavioral change. 5 or 10 years ago, this was exactly the reaction of pension funds. I need a return for my beneficiaries, I cannot do this. Now pension funds are big time into sustainability, they are beyond it. So my expectation is that central banks will live up to this logic in 5 or 10 years' time. But it's very strange that they're talking about it, but it is not applying to themselves. And I couldn't detect any trade-off between price stability and environmental. Like there is with unemployment, but on this side there is no trade-off. But it's just, I would say the German word Angst. So they are just afraid because it is not in their book back from university. It's not in the monetary textbook, so we cannot do it.
Good thing we have a new textbook.
Exactly. And then the deep question, and I leave the third question, how to integrate it. You have to be prepared to do a little bit of monetarization of the factors. But I always say, even if you put a value on nature, it doesn't mean it is for sale. So emissions, you can take 100 euro, dollar car, so you can. So I think there is coming more and more consensus on what is a good price for water, what is a good price for carbon emissions. So the life sciences and so on, the data are becoming available, and in that way we can evaluate and then start to compare. And I will put one restriction in. And that's, you cannot get worse. So even if it is profitable or environmentally nice to make a move, but if it would be socially going back, so you can put in your that you don't go lower on any of the aspects and then try to improve the whole lot. And how to get more teaching. I've written a column for Nick Robbins, who's at the Grantham Institute. And he still asked me, Dirk, can you give me the perspective for teaching? I think in the next 3 years we should solve it. But to be honest, I don't know how, because I'm just doing it out of enthusiasm. So I get my colleagues in the finance department with me. I know some other people are also using it for courses, but I'm sure that 80% of economics and finance teaching is still the Homo economicus portfolio theory. How to get it quicker. And it is needed because it is a new generation of asset managers and bankers. So you're right, how to speed it up. I hope we can make progress.
All right.
Let me start with this one, because I think there are ways to speed it up. One, for example, is as it was done, give a Nobel Prize to an environmental economist 3 months ago. And that's the greatest incentive for professors, because they live on teaching, selling books, and winning a Nobel Prizes. So if you give that incentive, I think it's already a good one. The second, of course, markets move faster than academia. But 3 years ago, to do this meeting would have been impossible. I mean, 3 years ago in markets, talk about sustainable finance, people would simply not be interested, and they would ask about Basel IV capital requirements. So I think the move from niche to mainstream, it happened very fast in markets. It may happen also quite fast in academia. At least I hope it happens fast in academia. Before going to the question of the colleague of MLEX, on the NGFS, because I happen to be, the Commission is invited ad hoc to those networks. I think there is an interesting convergence that is happening. There is the NGFS is the Network for Greening the Financial System, which is chaired by the Netherlands Bank, and the secretariat is by the Banque de France. And the network is very mondial. All the 5 continents are represented. A country you name it, a country you do not name it is not there. The country you name it is there. And all the other countries that you name it is there. And what they do is basically to figure out principles. I think I'm slightly more positive than you, to bridge exactly the two souls, to bridge exactly the financial stability souls and the price stability soul, which any central banker has. And the report which was issued 2 weeks ago in Paris, I think is a good demonstration. Interestingly enough, they are not alone out in the cold, because there is the network of the Ministry of Finance chaired by Finland and Chile, another odd couple like sustainable finance, but Finland and Chile chair a group of Ministry of Finance in order to mainstream sustainability into public spending. I started by saying that public spending is not enough, but the little that it is good to mainstream it. And then, of course, there is our EU taxonomy, but it's not the only one in town. The Chinese are elaborating something of that kind, and so on and on. The MLX colleague, I think the question is very well posed, but, negotiations are what the name says. I mean, you are there, you negotiate, you discuss, you convince one another. One thing I've understood in 25 years of career is that once you have finished your negotiations, they all supported. So at present, as I said, the agreement we have in the Parliament at present, I cherish. I think is a good basis, and from there we move on.
We had 2 questions. We had one back here in the back, and then one in the front row, and then maybe we'll hear from some others. Anyone else with a question for this round? We're going to start in the back. Okay, well, yeah, never mind. I'm always trying to come up with the efficient route,
Can you hear me?
Yes, thank you.
So good afternoon, Tom Verhey, European Commission, colleague of Mario. I'm a male, I'm sorry, I'm born in Beirut and I lived in Africa, so maybe that helps.
No, it doesn't, but thank you anyway for your contribution.
A very quick comment, apart from a big thank you for a great presentation, and I'm convinced to buy the book. That's number one. Secondly, a comment, as Mario said, I think it's vital that not only we take home the 2 out of 3 pieces of legislation, but also on the taxonomy, and we should be confident that will be happening as soon as possible. The comment is that I see a lot of traction on environmental accounting, including the monetization part, which we see as a fundamental addition to the toolbox that might solve some of the issues you were raising, Dr. Schoenmaker, and also were raised by the gentleman to the right. The question is, I was very interested in when you were rejecting the portfolio theory, but I was a bit lost. What was the alternative proposition you were bringing in? Would it be possible to quickly elaborate on that one? I will read your book, but thank you.
Okay, and then the gentleman in the tie up here in the front row, please.
Good afternoon. My name is Sean Murray from EUK Consulting. My question really is mainly for Mario, but I'd be interested in hearing the views of the panel. But it's to deal with really reorienting behaviours and transparency and taxation. Because, of course, if we're to achieve the SDGs, then governments need to have the tax income to be able to fund the healthcare, fund education. That's so important to these things. Now, there's significant public pressure, and I'm sure I don't need to tell you this, Mario, about corporations paying their fair share of taxation, and it be not just that they pay their fair share, they do it in the right place, and that they be seen to be paying tax in the right place. So my question really relates to, you listed a couple of significant achievements there with regulations. My question relates to the directive on public country-by-country reporting, which I think you're aware of. Now, there, of course, the European Parliament has been very supportive of your measures. However, the Council seems to be slightly divided. And I was just wondering if you could perhaps give me your thoughts on where that proposal is going and what the prospects are.
All right. And I am going to ask the third question, which is about a study that a friend of mine pointed out on Twitter yesterday, which I was really taken by, from an outfit called London Reconnections, about which I know nothing. But their study, which had tons of data and footnotes in it, said that when looking at public transportation, the policy planners are not looking at the needs, particularly of women. And this covers everything from public safety to what's considered essential transportation. Is it only to and from work, or does it include caregiving? If caregiving, taking care of your kids, your old people, your other members of the community, if that's not essential, you're going to design a very different looking public safety network. So I'd like to ask how those factors and the data we don't have are playing into what is truly sustainable, what is truly our planetary boundary, as Dirk said. So that's my question. Mario, why don't you start, and then we'll give it to Pascal, and we will let Dirk sum up at the end.
Okay, I leave Thomas to the other two, Dirk. Question of Sean. Let's distinguish the two things. I mean, myself and all the DG FISMA, we have done banking regulation for the last 30 years. We were used to slap capital requirements on banks and asset managers and all the alike. I have tried to explain why here we are using a different strategy, at least for the time being, which is the strategy of reorienting capital flows, transparency, and so on and on. And the reason is very simple, is because there is market pressure and there is an evidence of that. The second issue, which I think is sacrosanct, but outside my competence, is the one you are mentioning of taxes, and in particular the country-by-country reporting. There is very difficult for me to say anything different from what the Commission has put forward. The Parliament, as you said, has endorsed. The Council, in its own wiseness, for the time being, is not yet there. We'll see. I cannot say anything more, but I think the views of the Commission on these are quite clear, and they are in the proposal itself. So the proposal itself, I think, was quite obvious. Rebecca, on public transport and women, I am a male, but I have 3 daughters and 1 woman wife. So I live at home with 4, actually 5, because very often there's also my mother-in-law. So I live with 5 women at home. I try to take care of them as much as I can. And I actually think that probably inserting this issue of gender balance in all things that we do is essential. I tell you what I do very modestly at the Commission, and they all know it, my colleagues. Since 2011, when I was appointed director and I have this incredible power to sign for coffees, rooms, translators, and so on and on, I refuse to do it unless there is a woman on each panel.
Which we appreciate, because there is a difference between, I have met some women and I know some in my private life, and I'm working in an integrated public square, so.
So I always do it. I mean, I always do it, and I must say, at the beginning, and now it works fantastically well. I mean, now I don't even get requests unless there is a balanced thing. So. But I agree with you, that's an issue to be solved. By the way, there is a study of Columbia University that shows, is an econometric study, that shows that the best managers to promote women are not women, I'm afraid, but are men, father of daughters, because it's egoism.
I'm sure
think
you.
of their future. I haven't done this.
2 daughters.
I haven't done this study myself, but I think it's egoism, so that's what it does.
I would just like to add to that when you have people who are in a minority class, asking them to be responsible for the rest of their minority class is generally not a winning solution. And also, you shouldn't have to have a daughter and a dependent to be interested in an equal society. This is a sustainable finance event. If there's any place where we can move beyond that, I think this is the one. Pascal.
Maybe on portfolio theory.
Good call.
One of the problems of the way everybody's doing Markowitz, it's supposedly take expected returns on different asset classes. Some people do that, or they are just taking past performances on indices. although past performance is not a forecast for coming performance, but this is what everybody's doing. So you have to take benchmarks, indices, look at past performance, and try and project them. Results are poor, I would say. But this is what everybody's doing. Next, I would say expected returns based on what the experts are saying. Portfolio managers, they know best. Well, they know best. Well, they are the ones who have maybe the less probability of error. So just take their views on their asset classes instead of past performance of benchmarks.
And I will take the one on accounting. Accounting is extremely important because it fits in with transparency, and the more we can come to standardized reporting rather than specialized, and there is a great movement that's called integrated reporting. I know that the IFRS board in London is more conservative than conservative. So I encourage the Commission to take the lead here, because I think one of the great things is your regulation, the IAS regulation. Take the lead to promote integrated reporting, because then we get social, human and natural capital into the balance sheet. If we train our people, the value of the company increases. If we are careful with emissions, it increases the natural capital of the company. So it pays off to do. So integrated reporting is a great tool. I have a full chapter in the book on it. So the more you can endorse it as Commission, don't wait for the IFRS, because there it won't come from. And secondly, I have the best discussions in class with the mixed balance. And to be honest, the sustainability agenda is really about environmental and social issues. And my colleague, I run a platform, she comes from ethics. She always reminds me to pay sufficient attention to the social issues. And they are important because we've seen in France, if we move ahead and we forget about inequality, we don't make any progress. So yes, we need more voices to remind us that it is, the palette is bigger than just a few data points. So
one word on parity. It's been proven by different studies, and I experienced that myself with portfolio managers. Men are better at taking risks. Women are better at managing risk and cutting positions. Best of both worlds.
Absolutely. Maybe can I say maybe one word on integrated reporting and on the climate versus social? On integrated reporting, I think is probably the next frontier. But if I may, let's remember how difficult it was in 2015 with a target date of 2018 to have a very mild instrument like the Non-Financial Reporting Directive, which started as extremely flexible, which basically says, tell me what you do, and with an extremely restricted scope, which basically is the listed company, big, not even all the listed company, but the big listed company. So now today, of course, because we have mainstreamed sustainability, it seems to us that is very little, and I would even agree with you that with the eyes of today, that is very little, but let's remember how difficult it was in 2005. Second point on climate and social, I think that is very clear that we need to have an integrated view for the simple reason that climate investment tend to be socially divisive. I mean, are the rich who put the solar panel or buy the electric car? So not only they put the solar panel, but they even spend less in heating, and so they have more disposable income. So we really need to make sure that the access to investment, because at the end of the day, that it is the access to investment is possible for different social classes.
I'm thrilled to report that we have 5 whole minutes left. We are such efficient discussers of things. So if we have a last question, we can take one. Otherwise, Dirk, what a wonderful opportunity for you to sum up your book once again and any takeaways you'd like us to have on the way home. Again, thank you all for coming to Bruegel. It's been a real honor to have you here, and this is the fine book that we are celebrating today.
For the summing up, I think big issue, I think, is what Mario said, changing behavior. Yes, the book is normative, so the book shows what you can do. But the key thing is, that's my own personal experience, you first need to see it. Tonight is football, so let me finish with that. Johan Cruyff always says, he's in the Netherlands famous for his one-liners, you only understand it once you see it. And I think that's why I put this equation on that we integrate financial, social and environmental issues. Only when you are prepared to do that in your mindset, then everybody can do it in his own field, whether you're doing reporting or you're an accountant or whatever you do in your daily life, you can apply it. And I think that's the big challenge, that we are prepared to look beyond the obvious. And I think Pascal is right in saying that we have it in ourselves, because with GDP we all know that welfare is not only about how much money we earn, but more. So once we become back home to our human logic, we could make a lot of progress. And thanks for all coming.